What's up, everybody? Welcome back to the channel. My name is SM, and today we're diving into day trading, buying and selling stocks within the same day to profit from small price moves. Forget the jargon, we'll break down the 5 best beginner strategies step by step using simple visuals. Whether you're new or just curious, this is your foundational guide to day trading. If you find this helpful, smash that like button and subscribe for more wealth-building tips. Ready to learn how to make money from the stock market? Let's get started. Alright, let's get into it. First up, let's dive into the moving average crossover, one of the simplest and most popular ways to spot trends in the market. This strategy is a favorite among both beginners and experienced traders because of its straightforward approach and visual clarity. Imagine your trading chart with 2 lines, a short-term moving average which reacts quickly to price changes, and a long-term moving average, which moves more slowly and smooths out the noise. When the short-term line crosses above the long-term line, it's called a bullish crossover. This is a classic signal that the trend might be shifting upward, time to consider buying or entering a long position. On the flip side, when the short-term line crosses below the long-term line, that's a bearish crossover. This suggests the trend could be turning downward, so you might think about selling or even shorting the asset. The beauty of this strategy is its clarity. It gives you clear, rule-based entry and exit points, making it perfect for beginners who want to avoid guesswork and stick to a plan. By following these signals, you can avoid making emotional decisions and instead trade with discipline and confidence, knowing you have a system to guide you. But be careful, no strategy is perfect. In sideways or choppy markets, moving averages can get tangled, leading to false signals and whipsaws that can be frustrating for traders. That's why the moving average crossover works best when the market is clearly trending, either up or down, rather than moving sideways with no clear direction. For even better results, combine this strategy with other forms of analysis like support and resistance levels or volume indicators to confirm your signals. The moving average crossover is a fantastic way to start learning how to read trends and make disciplined, systematic trades. Try opening a chart and adding a 20-day and a 50-day moving average. Watch how they interact and notice when crossovers happen. Practice spotting these crossovers. They're your first step in understanding how trends develop and how you can ride them for potential profits. Simple, visual, and effective. This is a must-know tool for every new trader looking to build a solid foundation in technical analysis. Ready to level up your trading toolkit? Let's move on to the next strategy. Transition to next scene. Now let's talk about breakout trading, catching big moves as they start. This strategy is all about spotting the moment when a stock escapes its usual range and begins a powerful new trend. It's like catching a wave just as it forms, giving you the chance to ride the momentum from the very beginning. Stocks often bounce between support, which acts as a price floor, and resistance, which serves as a price ceiling. These levels are where buyers and sellers tend to clash, creating a zone where prices pause or reverse. When a stock breaks above resistance with strong volume, it's a bullish breakout. Jump in. This signals that buyers have overpowered sellers, and a new upward trend could be starting. If it falls below support, that's a bearish breakdown. Consider selling or shorting. This means sellers are in control, and the price may continue to drop. The key is volume. Real breakouts come with a surge in trading activity. High volume confirms that many traders agree with the move, making it more likely to last. Watch out for fakeouts, brief moves above resistance that quickly reverse. These can trap traders who jump in too early, so patience and confirmation are crucial. Always use a stop loss just below the breakout point to limit risk. This way, if the breakout fails, your losses are kept small and manageable. Set profit targets or use a trailing stop to lock in gains as the price moves in your favor. This helps you capture profits while letting winners run. Breakout trading is all about timing and discipline. You need to be ready to act quickly, but also stick to your plan and not let emotions take over. Identify clear support and resistance, wait for a decisive move, and act fast. The best breakouts are obvious and leave little doubt. This strategy gets you into trends early, but only if you manage risk carefully. Remember, not every breakout leads to a big move, so protect your capital. Practice spotting breakouts on charts and always protect your downside. The more you practice, the better you'll get at telling real breakouts from fake ones. Ready for more? Let's keep going. Transition to next scene. Momentum trading is all about riding the hottest stocks that are moving fast in one direction, often fueled by excitement, news, or big events. The goal is to catch a wave of buying or selling pressure and ride it for as long as it lasts, getting in and out before the momentum fades. To start, look for stocks making big moves on high volume. These are usually triggered by breaking news, earnings surprises, or major announcements that get everyone's attention. Use stock screeners to quickly spot stocks up 5% or more with unusual volume spikes. These tools help you filter out the noise and focus on the real action so you don't waste time chasing slow movers. Next, study short-term charts for sustained trends. Look for a pattern of higher highs and higher lows which signals strong momentum. This is where you want to focus your attention. Enter your trade during a brief pullback within the uptrend. This gives you a better price and increases your chances of catching the next leg up, rather than buying at the very top. Always place your stop loss just below the recent low to protect yourself from sudden reversals. Risk management is key. Never risk more than you can afford to lose. Take profits actively. Momentum can fade quickly, so don't get greedy. Lock in gains as the stock moves in your favor, and don't hesitate to sell if the trend starts to weaken. Sell portions as the stock hits new highs, or use a tight trailing stop to protect your profits while giving the trade room to run. Momentum trading requires quick decisions, sharp focus, and the discipline to stick to your plan even when emotions run high. Remember, it's not about catching the entire move, just aim for a solid chunk of the action and get out before the momentum fades. Stick to the strongest stocks, manage your risk carefully, and you'll put the odds in your favor over time. Consistency and discipline are what separate successful momentum traders from the rest. Practice on a demo account before going live. This helps you build confidence and refine your strategy without risking real money. Now that you know how to catch momentum, let's move to the next strategy. Transition to next scene. Scalping is all about making dozens of quick trades for tiny profits. Scalpers trade highly liquid stocks with tight bid-ask spreads. Think Apple or Tesla. They're in and out in seconds or minutes, aiming for a few cents per trade. Speed is everything. Use a fast broker and hotkeys for instant orders. Discipline is crucial. Never let a small loss turn into a big one. Stick to your stop loss, no exceptions. Watch level 2, data and time and sales to read real-time order flow. Scalping is intense and can rack up commissions, so be mindful of costs. It's advanced for beginners but teaches discipline and risk management. Even if you don't scalp, understanding it sharpens your trading skills. Try it in a demo account to see if it fits your style. Next up, spotting reversals. Transition to next scene. 15. Reversal trading is about catching the moment a trend changes direction. Look for signs of exhaustion, like long wicks on candles or price stalling at highs or lows. Use indicators like RSI for divergence. If price makes a new high but RSI doesn't, momentum is fading. Wait for confirmation, a break of support or a trend line, before entering. Always set a stop loss just beyond the recent high or low to limit risk. Reversal trading is risky and requires patience. Don't jump in without clear signals. Practice spotting reversals on a demo account before risking real money. Mastering reversals helps you take profits and find great entry points. Use this skill to complement other strategies. Let's wrap up with some final advice. Transition to next scene. 13. That's it. The 5 best day trading strategies for beginners. Each requires discipline, patience, and strong risk management. Always practice in a demo account before trading real money. Start small, scale up as you gain experience. Which strategy excites you most? Let me know in the comments. Subscribe for more trading and investing tips. Thanks for watching. See you in the next video. Good luck on your trading journey.